Silver is tracing the same vertical arc that preceded the 1979 to 1980 eruption, and the numbers now running through the market leave little room for a softer outcome. Prices have already broken every modern resistance level. Inventories at the major exchanges are collapsing at a pace without precedent since the Hunt brothers forced the system to its limits. And the structure of today's market, leaner, tighter, and far more leveraged, suggests the next leg higher is not speculative excess, but arithmetic pressure. This pressure shows up in small signals that rarely appear together. Spot prices trade above futures, a condition that forms only when buyers demand immediate metal rather than deferred promises. Delivery requests strain inventories that cover only a fraction of outstanding contracts. Major industrial users increase forward purchases to secure supply, pushing the market into a pattern that resembles a slow-moving bank run. The chart reflects this tension clearly. Each surge, each retracement, each consolidation mirrors the structure that drove silver from $6 to $49 in 18 months in 1980. But behind today's pattern sits a far larger engine, a multi-year supply deficit, record industrial consumption, and a monetary environment approaching its own breaking point. This means the current trajectory is not a repeat of 1980 in narrative alone. It is a repeat in form, in pressure, and most importantly, in mathematical inevitability. And as the curve steepens, the destination implied by the numbers increasingly clusters around one figure, $150 per ounce. The path to that level starts with understanding where the market stands today. Silver's market behavior signals a system entering structural tension. Prices press against new highs with a steadiness that resembles conviction rather than speculation. The move is unfolded alongside shrinking liquidity in the physical market, where available supply has thinned to levels that no longer match the volume of outstanding claims. This imbalance, once theoretical, is now visible in the way traders position and institutions hedge. Recent trading sessions reveal a market that prefers certainty over convenience. Spot prices hold above futures contracts across multiple maturities, an anomaly that only forms when participants doubt the system's ability to deliver metal months from now. This inversion is subtle but decisive. It tells us buyers are not paying for time, they are paying for immediacy. They want silver now, not silver promised later. That shift rarely reverses without substantial inventory replenishment, and inventories continue to fall. Exchange data reinforces the trend. The pool of registered silver, metal available for delivery, now represents only a sliver of total open interest. Withdrawals accelerate even on days when prices consolidate, suggesting industrial users and large holders are treating physical metal as strategic inventory rather than trading collateral. The drawdowns resemble early signs of stress in a monetary system, small but consistent outflows that gain speed as confidence fades. Parallel to this pressure, broader macro conditions amplify demand. Real yields weaken as markets prepare for policy easing. The dollar softens at the margins. Investors rotate back toward tangible assets as insurance against monetary dilution. Silver, straddling the line between industry and money, absorbs this flow with unusual speed. The metal behaves less like a commodity and more like a currency under pressure. Behind these movements sits a market infrastructure stretched thinner than at any point since the 1980 spike. Paper liquidity remains abundant, but the physical reserve supporting it narrows each month. The divergence creates a price structure where equilibrium can no longer be maintained by derivatives alone. When the foundation shrinks, pricing authority shifts from paper to physical. That shift is already underway. This is the environment silver trades in today. A market defined by record prices, tight supply, fragile liquidity, and rising preference for real metal. And these conditions set the stage for the forces driving demand even higher. Behind the tightness in today's market sits a demand engine that has no historical parallel. Industrial use, once a secondary factor, now absorbs more than half of global silver consumption. Each new technology cycle reinforces this shift. And unlike investment flows, which rise and fall with sentiment, industrial demand embeds itself into production lines and cannot pause without economic cost. The largest driver comes from the energy transition. Solar manufacturing has become a structural force, not a cyclical one. Each photovoltaic cell requires silver paste for conductivity, and efficiency targets leave little room for substitution. Installations climb each year as governments mandate renewable capacity. Companies are not buying silver for speculation. They're buying it to meet legally binding build-out schedules. This transforms demand into something closer to obligation and preference. Electric vehicles add another layer of pressure. Modern EV platforms rely on high conductivity components for battery management, power electronics, and safety systems. Each vehicle uses multiple times the silver of a combustion car. As automakers scale production, their procurement strategies shift from opportunistic purchasing to multi-year contracting. That locks in consumption patterns at levels the mining sector cannot match quickly. Broader electronics markets reinforce the same trend. Data centers, 5G infrastructure, medical devices, all depend on silver's unmatched conductive properties. These sectors operate on global replacement cycles, measured in months, not years. The result is continuous draw on supply, even during economic slowdowns. Demand softens at the margins, but the core requirement persists because the systems themselves cannot function without the metal. Then comes the monetary dimension. Investors increasingly treat silver as a hedge against currency dilution rather than a speculative trade. Balance sheets expanded across major central banks. Real rates fluctuate around levels that do not compensate for accumulated inflation. Under these conditions, the market gravitates toward assets with fixed supply. Gold captures the headlines, but silver captures the torque. It responds more sharply to shifts in monetary expectations because the industrial base magnifies every incremental dollar of investment demand. A second monetary driver emerges from geopolitical realignment. Nations securing strategic reserves view silver differently from past decades. China consumes more than it produces and imports steadily to feed industrial expansion. Russia has moved to classify silver alongside other critical metals in its reserve structure. These decisions are not declarations of price targets. They are responses to a world where foreign reserves can be frozen, trade routes disrupted, and supply chains politicized. Physical metal becomes insurance against financial weaponization. All these forces converge on the same point. Demand is no longer elastic. Technology requires silver. Policy requires silver. Strategic positioning requires silver. And each category grows independently of the others. This creates a compound effect where rising consumption is not driven by one sector, but by an entire global system entering a phase of simultaneous modernization. This is the demand landscape, structural, accelerating, and largely non-negotiable. And it meets a supply base that is aging, constrained, and increasingly unable to respond. Silver supply is entering a phase where geological limits and economic realities collide. Mine output has struggled to expand for nearly a decade, even as demand accelerates. Production peaked years ago and now drifts along a flat line that conceals a deeper issue. Most of the world's silver does not come from primary silver mines. It comes from copper, lead, and zinc operations, where silver is extracted as a secondary benefit. That structure removes the industry's ability to respond quickly. If base metal prices do not justify new projects, silver supply remains capped, regardless of its own price trajectory. The deposits that once delivered high-grade ore are aging. New discoveries are smaller, deeper, and more expensive to process. Bringing a mine from exploration to production takes 7 to 10 years under favorable conditions, and even longer under the current regulatory environment. Cost inflation in labor, energy, and equipment adds another layer of friction. These constraints turn supply into a fixed variable over the medium term. Higher prices may improve margins, but they do not magically create new metal. The second constraint emerges in inventories. Exchange stocks have been draining at a pace that no longer resembles normal trade flow. Registered silver, the portion available to meet delivery obligations, has shrunk to levels that cover only a fraction of outstanding claims. Eligible material still sits in vaults, but much of it belongs to holders with no intention of offering it to the market. When withdrawals outpace replenishment for consecutive years, the buffer between physical demand and systemic stress thins rapidly. London's vaults reflect the same trend. Holdings trend lower as financial institutions reposition and industrial users source metal outside traditional supply channels. Inventories once considered abundant now represent only months of global consumption. When strategic buyers move consistently and supplies shrink steadily, the point at which the market loses flexibility approaches faster than headline numbers suggest. Recycling offers little relief. Electronics contain silver in quantities too small to recover efficiently. Many devices end up in waste streams where extraction is uneconomical. Solar panels, one of the fastest growing sources of industrial consumption, lock silver away for decades. Even aggressive recycling initiatives cannot offset rising demand. The flow of reclaimed metal remains stable, not scalable. These constraints produce a structural deficit that compounds each year. Consumption exceeds production, inventories bridge the gap, and the bridge narrows with every drawdown. Markets can function under strain, but they cannot function without reserve capacity. Once the system crosses that threshold, price becomes the mechanism that decides who receives metal and who does not. This narrowing margin is no longer hidden. It feeds directly into the market behaviors, now reshaping silver's price structure. And as supply tightens, the reactions across financial markets, industry, and investment channels begin to accelerate. As supply tightens, the market begins to reorganize itself around scarcity rather than expectation. The first signs emerge in the future structure, where liquidity normally cushions volatility. That cushion is thinning. When spot prices trade above deferred contracts, the system signals immediate stress. Buyers are no longer negotiating on convenience. They are challenging the premise that metal will be available months from now. This inversion, subtle at first, marks the early stages of a market shifting from abundance to allocation. The impact spreads quickly through financial channels. Short positions face rising delivery risk. Exposure that once appeared manageable becomes a liability as inventories fall. The cost of rolling contracts increases. Margins widen. Volatility compresses into sudden, disorderly moves as traders adjust ahead of time. The paper market, built on the assumption of ample backstop metal, begins to lose its ability to dictate price. Authority shifts from derivative screens to physical vaults. Industrial buyers amplify this shift. Manufacturers accustomed to predictable supply chains confront the possibility of delayed shipments or uncertain replenishment. Their response is rational. They secure material early. They extend orders. They avoid reliance on in-transit supply. This behavior resembles precaution rather than panic, but the effect is identical. Forward demand pulls additional metal out of the system, accelerating the drawdown that triggered the concern. Financial markets react on a parallel track. Investors tracking inflation, currency stress, and liquidity cycles rotate into hard assets. But silver responds with greater torque because it sits at the intersection of two narratives: industrial necessity and monetary protection. Small flows from investment channels add disproportionate pressure to a market already strained by industrial consumption. Each new allocation tightens the balance further. The gold-silver ratio introduces another layer of mechanical tension. Gold establishes a new price range as monetary conditions evolve. Silver lags, then accelerates as historical relationships build higher. The ratio does not close gradually, it snaps. When the market recognizes that silver remains mispriced relative to gold, capital rotates quickly. Even partial reversion can add tens of dollars to silver's price without any change in supply fundamentals. Stress also emerges in ETFs and structured products. These vehicles promise exposure, but rely on underlying metal for credibility. When physical supply tightens, questions arise about allocation, sourcing, and deliverability. Small discrepancies between fund holdings and vault reports can trigger large inflows or sudden redemptions. Either outcome forces the system to locate real metal. And locating real metal becomes harder each quarter. The final chain reaction comes from risk management. Exchanges raise margin requirements to reduce vulnerability. Banks widen spreads to limit exposure. Traders adjust algorithms to account for illiquidity. These steps do not solve the underlying issue. They simply shift the burden onto participants who need certainty, not leverage. As conditions tighten, the probability of sudden discontinuities rises, the kind of gap moves seen in past commodity squeezes when physical scarcity overtakes financial structure. This is the phase where the market stops behaving like a stable system and begins to act like a compressed spring. Tension accumulates quietly, then releases abruptly, and the release often arrives not from a crisis, but from a single catalyst that exposes how little metal remains beneath the surface. The forces shaping silver's trajectory now converge toward outcomes that differ only in intensity, not direction. The baseline scenario assumes continued deficits, steady industrial growth, and moderate monetary easing. Under these conditions, pricing adjusts upward as inventories shrink and forward contracts reprice delivery risk. The climb appears gradual at first, but each incremental shortage strengthens the structural floor beneath the market. Price becomes less about speculation and more about securing participation in a finite supply chain. A stronger scenario develops if inventory exhaustion arrives sooner than expected. Registered stocks fall to levels that no longer buffer demand shocks. Industrial buyers, unable to tolerate production delays, move from precautionary buying to competitive buying. Their bids set the marginal price, not investors. In that environment, silver does not drift higher. It re-anchors at levels that reflect scarcity rather than history. The $80 to $100 range becomes a transitional zone, not a destination. A more forceful outcome emerges if financial stress intersects with physical shortage. Rate cuts, currency repricing, or liquidity interventions can amplify investment flows at the same moment industrial users increase procurement. Two demand curves, one monetary and one physical, converge on the same shrinking pool of metal. Markets with limited supply do not absorb dual shocks evenly. They lurch to new equilibrium points. Under these conditions, triple-digit pricing is not speculative. It becomes the mathematical response to competing claims on constrained resources. The most disruptive scenario occurs if paper markets face deliverability questions. A missed allocation, a delayed shipment, or a concentrated demand request can expose the thin layer of metal supporting the future structure. Once confidence weakens, the system shifts from presuming convertibility to doubting it. Cash settlement rises. Physical premiums widen. Prices diverge by geography as metal flows toward the highest bidder. In that environment, $150 is not a ceiling. It is a clearing price, an attempted equilibrium in a market sorting scarcity. Macro conditions amplify all paths. Energy transitions continue. Defense spending expands. Digital infrastructure accelerates. None reduce silver demand. At the same time, mine supply remains static and project pipelines thin. Even optimistic projections do not close the deficit in a meaningful timeframe. When long cycle supply meets short cycle demand, the adjustment occurs through price, not production. This creates a future defined less by volatility and more by recalibration. The market transitions from decades of abundance to an era of constrained availability. Investors adapt, industries adapt, financial structures adapt, and the adjustment lifts silver into a range that aligns with its industrial role, its monetary relevance, and the physics of constrained supply. This is the direction indicated by the data. Not a straight line, not a sudden explosion, a structural repricing, with a destination increasingly centered near one outcome: a silver market that finds stability only after it crosses the threshold long considered improbable. Silver now sits at the intersection of structural scarcity and monetary recalibration, and that intersection reshapes the price landscape more forcefully than any trading narrative. The deficit is persistent, inventory buffers are thin, industrial dependence deepens with each technological cycle, and the monetary environment continues to erode the value of assets untethered to physical constraints. These conditions do not coexist peacefully. They converge into a single, directional outcome that markets can delay but cannot avoid. The chart from 1980 offers the clearest analog because it reflects the same underlying mechanics: tightening supply, accelerating demand, and a financial structure that presumed more metal existed than the system could deliver. But the present cycle carries a larger scale. Industrial consumption is higher. Inventories are smaller. Global monetary bases are far larger. The forces repeating the 1980 pattern are stronger than the forces that created it. In the end, price becomes the only mechanism capable of reconciling these pressures. Not because markets prefer higher levels, but because the physical system requires them. A A world consuming more silver than it produces must discover a clearing price that restores balance. And the trajectory implied by today's fundamentals clusters around levels that once seemed extreme but now appear inevitable. The pattern is repeating, the pressures are compounding, and the mathematics point toward a horizon where 150 silver is not a speculative target, but the next rational equilibrium in a market outgrowing its old boundaries.